All right, welcome to this explainer. If you've been keeping an eye on the global markets lately, you're probably seeing what looks like absolute chaos. Today, we're going to unpack a massive, honestly unprecedented collision of two totally distinct macroeconomic shocks that are hitting the global economy and your wallet at the exact same time.
Look, if you woke up this morning, checked your investment app, and just saw a giant sea of red, I know exactly how that feels. It's totally natural to feel a spike in anxiety when your hard-earned investments start bleeding. But rather than panicking, we're going to logically step back and unpack exactly what is happening behind the scenes. Okay, let's dive into this. Here is our roadmap. First, why are markets crashing? Then the Middle East oil shock, the rupee under severe pressure, the US AI bubble, and we'll wrap it up with some smart investing strategies. We're going to connect all these dots across the globe to make sense of this.
Starting with Section 1, why are markets crashing? The immediate impact. Let's look at the very real drag happening across the Indian financial landscape right now.
Now, what's really interesting here is that this bleeding is incredibly widespread. It's not just isolated to one weak industry. The Nifty slipped heavy, dropping over 160 points below that 24,052 mark, and Bank Nifty took a hit of more than 1%. We're seeing massive sell-offs across the board. Auto, PSU banks, IT, FMCG, even the giants, large caps like HCL Tech and Tata Motors, they aren't immune. When you see a broad sell-off like this, it's a massive red flag that the pressure is coming from heavy, external global forces.
And that brings us right to Section 2, the Middle East oil shock, the geopolitical catalyst. So what exactly is that external force dragging everything down? Well, let's trace the rapid sequence of events in the Strait of Hormuz. This is literally one of the world's most critical choke points for oil. So months ago, the US-Iran ceasefire completely collapsed. Fast forward to just days ago, and UAE oil tankers along with an advanced US drone were struck by missiles. In response to all this, the US demanded a 20% cargo security tax for safe passage, a move that Iran is heavily contesting. Economically speaking, this geopolitical chokehold has severely paralyzed a vital global trade route.
And the direct result of a paralyzed trade route, a massive price spike. Brent crude oil has shot straight past $86 a barrel. That is a 10% jump in just a matter of days. And the major fear on Wall Street and Dalal Street right now is that this escalation could easily spark a return to crude hitting $100 or maybe even $120 a barrel.
Let's move to Section 3 and see how this builds. Rupee under severe pressure, the economic fallout.
So India imports over 80% of its crude oil requirements. Because of that, every single time oil prices spike globally, it hits us incredibly hard at home. The sheer cost of buying this ultra-expensive crude has battered the Indian rupee down to a historic low, actually crossing 96 against the dollar. Importers are basically scrambling to buy expensive dollars just to pay for this expensive oil, and it creates this vicious cycle of currency depreciation.
And here is why that expensive oil and falling rupee actually matters to you. Right now, retail inflation, which is what everyday shoppers feel at the store, looks relatively tame at 4.38%. But behind the scenes, producers and companies are absorbing a massive 9.68% inflation shock on the wholesale side. Companies are eating that cost right now to protect consumers. But if crude oil stays elevated, that dam is going to break, and those massive costs will inevitably be passed straight down to you and me. Okay, let's pivot totally. Section 4, the US AI bubble, the tech shock. While oil is causing traditional economic pain, there is a very different, highly expensive bubble looming in US tech stocks.
For the last 30 years or so, tech giants like Microsoft dominated because traditional software is practically free to copy once you build it. But AI? AI isn't traditional software. Think of it more like a massive, high-end restaurant kitchen. When you ask an AI a long question, you aren't just copying a file. You're forcing power-hungry servers and incredibly expensive NVIDIA chips to literally cook an answer for you from scratch. Every single user prompt burns expensive ingredients in computing power, meaning the more users they get, the larger their cash burn actually becomes.
And this brilliantly illustrates a huge problem. Because AI is so expensive to run, companies charge businesses by the token, which is basically by the word. Alex Karp, the CEO of Palantir, recently pointed out that corporate America is deeply frustrated by this. They view this pay-per-token model almost like an unfair wealth tax. Plus, companies are terrified that if they feed their internal trade secrets into these models to get work done, the AI might actually learn those secrets and inadvertently train their competitors.
To support this wildly expensive technology, the US is spending unbelievable amounts of money.
To put that into perspective, the United States is pouring an estimated $764 billion, that's roughly 3% of its entire economy, into AI research and these massive data centers. Compare that to China, which is spending just $102 billion. The US is banking absolutely everything on a $1 trillion future payoff.
But here is where the US tech monopoly faces a really serious challenge. The US builds these frontier models completely from scratch, pouring billions into research and energy. China, on the other hand, utilizes a process called distillation. Basically, it's like copying the topper's homework. They study the outputs of the expensive American models and train their own models to just clone those answers. The result is highly effective open-source AI models that cost a fraction to operate, severely undercutting the American pricing model.
So the crucial point is this. We have a situation where US tech is spending trillions on back-end hardware while their actual AI models are bleeding money and being undercut by cheaper global alternatives. Legendary investors like Michael Burry are warning that chip stocks and back-end hardware valuations are at their highest in 15 years. I mean, that signals a dangerous artificial inflation. If big tech CEOs suddenly wake up and decide they need to pull back on this massive AI spending, this hardware bubble could violently pop.
Finally, Section 5. Smart investing strategies. Protecting your wealth. How exactly do we navigate all this turbulence? Let's talk solutions.
So here is the game plan top wealth managers are recommending right now. First off, take a deep breath. Do not panic sell into the crash. Instead, look to actively rebalance. You want to maintain a 10 to 20% international diversification, but maybe move away from being entirely reliant on US tech. Look into non-tech sectors like healthcare or even markets like Europe and Japan. Shift your focus toward quality and value-focused ETFs that invest in solid, genuinely profitable companies. And finally, when geopolitical uncertainty is this high, allocating about 8 to 10% of your portfolio into safe haven commodities like gold and silver is a very, very smart defensive play.
Also, it's incredibly important to remember that there are real bright spots right here at home, even amidst all this global chaos. Take 1.5 lakh crore. That is the massive anticipated budget for India's Semiconductor Mission 2.0, which is clearing its final approvals right now. While the world navigates conflicts and tech bubbles, our domestic infrastructure and manufacturing remain incredibly strong beacons of growth. We're actively building the ecosystem here, and that presents a fantastic long-term opportunity for the smart investor.
Well, we've covered a lot of ground today, untangling this really complex web between your investment portfolio, Middle Eastern geopolitics, and Silicon Valley data centers. But I want to leave you with a final, provocative thought to chew on. As we navigate the rest of this year, what do you think is going to break first? Will that massive US AI spending bubble finally pop? Or will geopolitical tensions push crude oil past that dreaded $100 mark, crushing global currencies in the process? Keep a very close eye on these two macro shocks because they are absolutely going to define the financial landscape in the months to come. Thanks for joining this explainer, and as always, stay curious.